All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market, still going. It's a heavy pace of movement, a very heavy pace of movement. We have seen the market today make multiple 2% moves, which is just pretty insane, given what the markets have been the last 5 years. You can see S&P futures right here at about 3070, just shy of 3070. It comes down to 3006. So about a 2% move down from the time the market, just about 10 minutes after the market opened, till about an hour later. So about 1 hour time period, we get a 2% move down. In less than an hour, we get another 2% move up. Okay. Then we have this nice little shallow, 35-point move, 1% move down. And then we get a nice little 2% move up, right? And there we go. We're looking at a market that's just ready to go, ready to take off again. No, another 2% move down. And you can see even just chopping through this 20-point range in 6 minutes. It's an incredible pace of movement that is driven on some massive volumes as the computer algorithms are turned all the way up. Here with this level of movement, and the uncertainty elements continue to increase, and this type of chop and volatility only increases uncertainty. It doesn't do much to decrease it there, and there aren't a lot of safety areas out there for the market. There are a couple things that are just a little bit jaw dropping when you take a look at them. Let's start with the FXI. This is the Chinese market. Yeah, the last 2 days where where U.S. equities have plummeted, the FXI is positive. Now, the FXI plummeted here in January while global stocks held up and moved into new highs. So it's one where, yes, it has lagged overall, but global markets have now played catch up to what the FXI did. And the FXI is holding up. We're not seeing the intensity of selling here within the FXI. Now, things like Alibaba, they're much more like the FXI, and some of the other stocks are catching up here to them. But very interesting to see. Also interesting to see something like a Wynn Resorts in the green here today. Now, it is only traded in a $12 range, which is, incredible. But it's sitting in the green. And then we have gold, which is up today, up about 50 cents. And then we have the gold miners, which are getting taken out to the woodshed and beaten. They are absolutely getting drummed. GOLD, Barrick Gold, getting hit very hard, which is something that, frankly, I'm happy to see, because I want back into the upside. And the only way I get that is on a pullback. And it has a downside 3-7 cross on it here today if it holds like this. Now, it's not a bearish signal to go out and trade. But it does mean that there is a potential for a new bullish signal setup going forward here. But monster volume in this as well. Gold miners lagging gold in a big way, and speaks volumes to the fact that the market doesn't feel safe. Take a look at some of the traditional safe havens for the market: Coca-Cola, AT&T. Just not very safe. We're seeing aggressive selling in a Procter and Gamble. You say, well, a lot of times healthcare, nice little safety trade. Healthcare is getting hammered. Johnson and Johnson getting hammered. We're not seeing that safety element here. And then you look at utilities, which has been the poster child for safety trade. it's getting hammered here as well. So we're not seeing the safety areas hold up. We're not seeing the aggressive areas hold up. We are seeing individual kind of plays like a Netflix and whatnot hold up. But in general, there's not a lot of places to hide in this market, and that is a market that we haven't seen for quite some time, where there just simply isn't a good hiding spot for investors, and that leads to a lot more volatility, a lot more kind of chaotic price action, and on very high volume. So high pace, high volume. Market vibe here today is a -9, so still strongly bearish. Take a look at this bullish percent index plunge. This is yeah. There's just no other real great word for it. We have seen the number of stocks that are running with bullish signals on point and figure charts was here at about 78 at the end of last week. It is dipped down to 36 here today. One of the strongest moves in the bullish percent index that we tend to see. If we go back further in time, we'll see some moves that are similar to this. Let's take off the log scale, but here's 2 years. You can see we had a move here in August that was pretty hefty. Okay, but nothing to this magnitude. The last time we had it to this magnitude was in December of 2018, but that took 2.5 weeks to emerge. This has taken 4 days. So the speed, the pace in which we're just seeing the erosion here in many of the metrics is pretty incredible. Now, this isn't something where you look and you say, well, because it's moved this far down this fast, it means that we have to go on down. I mean, we saw this back here in 2018, and market had a sell-off, a little bit up and down, but, recovered pretty nicely. It's not unprecedented, but it is pretty incredible in terms of how quickly it has happened here. When we look at things like a NYAD, the advancers versus decliners issues, this is still a market that's mass move. It's all in or all out. It's not one that has a lot of differentiation in it. And then if we take a look at the number of stocks hitting new highs versus new lows, this is, to me, the biggest warning sign that the market is giving that the sell-off may have just begun. Now, I'm not saying that is the case, but as far as a warning sign for that, we have more than 500 stocks on the New York Stock Exchange setting new lows than new highs. That is the highest number in well over a year. And if we back this out and we take a 5-year view of this, we had this happen back here in 2018 in September and October, where we had this many new lows come in. And the markets rebounded a little and then took another pretty sharp drop, here in them. And so we're playing in an area that's dangerous, but we're also playing in an area where we had a lot more new highs here of late. And the tendency is that when we get that, the next big shot down tends to be a nice little buying opportunity, and then we tend to get new highs kind of diverge to the downside, and then another hard sell. But it is one where the warning signs continue to grow, the paces continue to grow, and we see option spreads kind of gaping open with a lot of stocks here, and in a way that we just haven't seen in a very long time. So a shakeout, a shakedown, whatever you want to call it. Obviously, there are a million different opinions on what the market is and what it could be and what it's going to do, tomorrow and the next day and all of that. But as far as hey, you know what, this is now a time to really just step in aggressively. No, it simply is not. on a historical basis. Can you pick up a few things here and there as you'd like? Yeah, why not? But you can't pick something up and go, well, if the market tanks, my GOLD is going to be safe. And we've talked about this till we're probably blue in the face. And this is not a market safe haven. It wasn't, hey, the market's going to go down when we were buying into it. It wasn't a, hey, the market's going to go up when we sold out of it. It is its own, it's to its own devices here. And yeah. So anyway, that's the market. There are no new challenge signals here. We have Dollar General and GOLD with downside crossovers today, but both coming off of new highs. Neither are signals here to be traded, and so going to go into the close here today with cash. Now, one thing I want to take a look at is a question that came in. And it said, the question, I'm just going to read it here. It says, does this move, meaning a move in the market, change the expected price levels of individual stocks drastically? The companies that come out and announce change in guidance and expectations is one thing. But what about the ones that don't? I had ideas of where stocks that I am watching would go in the next few months. I'm not sure that will change if they don't come out and warn. So this is a question from somebody looking more from an investment standpoint, who has been lightly exposed in the market, who wants to put some money into play when the time is right. So let's use Chipotle Mexican Grill as an example, because this is a stock that I'm not in. I have been on the sidelines and kind of regretting it for a little bit, and now pleased with my sideline choice. But this is one that I want to be a buyer of. It is one where when I go into the stock fundamentally and take a look at where some of the fundamentals sit, so price to book value, well, that's not very meaningful when it comes to Chipotle Mexican Grill, but it's at 12. It's very high. Even with this pullback, it's very high. What about a price to sales ratio? Well, it's at 4. Okay, it's lower, right? But it's not in these cratered positions. And for most stocks, that's going to be the case, to where when we bring up the price to earnings, when we bring up the price to sales, the various fundamental metrics, we're not going to see that all of a sudden stocks have gone from overvalued and really expensive to now super cheap and no-brainer buy. That they're not doing that. They are moving in a territory where they're just a little bit less overvalued fundamentally than what they have been. And let's face it, many stocks have been overvalued fundamentally now for a year and a half. So it's not like it was just the rally over the last several weeks that put them into this overvalued situation. So we're not going to see overvalued or undervalue come into play quickly with a lot of stocks. To get that to happen, we're going to need to see a multiple month type of sell-off emerge in the market to kind of see that element. So the question of price expectations. Do you look and do you say, well, you know what, my price expectations are different? I think you have to adjust an understanding of how much they can pull back, how aggressively they can pull back, but know that if you're going to go in and buy, for instance, a Boeing, okay, you can't go in buying this thinking, oh, it's going to be immune to more selling, because it's not. There simply is not enough cheapness coming in to stocks across the board, as well as in a lot of the major individual pockets, to say, well, you know what, I was expecting this thing to hold 320. Now maybe 280. I think it's arbitrary. We would have to start seeing a stock like Boeing dip below 200 to start looking and saying, okay, Boeing is now really cheap on a fundamental level. It's really inexpensive on a fundamental level. And I mean, the last time we saw Boeing cheap on a fundamental level, it was trading down in the $120 area. So with a lot of these stocks, if you just back them out to a weekly chart, it's going to suggest that there is plenty of room to the downside. And so, okay, where do you jump in? Where do you get in? Where do you start to kind of say, all right, now I want to be interested? It's not going to be based on fundamental price levels, and it's not going to be a price level that you can just arbitrarily pick. You have two options. Number one, watch the price action, understand where some of the biggest volume comes in, and you can see a support level potentially marked. We haven't seen many of those at all, if any. We haven't seen them in Chipotle. We haven't seen them in Boeing. And so you can look for that and wait for that. And then the second thing is, okay, you want into Boeing? Fine. When does it close above the high from the prior day? Right? When does it close above the high for the prior day? And when that happens, it's going to be a lot more interesting as far as from a risk-reward standpoint, as far as from a, hey, are these price levels significant standpoint. Day trading. Been doing a little bit of that here today, and been using the simple idea and concept of, hey, we close above the high from the prior candle. All right, there's my opportunity. We close below the low from the prior candle. Okay, there's my opportunity. I caught one small dip in the market right here. And we had this kind of close above the high from the prior candles. I didn't buy it. I thought to myself, I suspect we're going lower. So what did I want to see? I wanted to see that we had a close below the low of the prior candle. And we got that right here. Now, I wasn't able to jump out on it right away. It is something where, things are moving pretty quickly. And so I decided I want a 2-candle confirmation. And I got that right here. The 2-candle confirmation. And was able to go and short the market right here. Now, did it just flush and, everything great? No, it didn't. But it gave me an area where I could say, all right, I'm going to short the market. My stop is on these highs right here. And go. All right, great, fine. It worked out. Nice, thank you. I'll take it. And looking for that same thing, right? We have we have this big candle right here, this big down candle. Okay, maybe I want to be a buyer when we close above the high from this candle. Problem is, it didn't happen for like 20 minutes. It took it quite a while. And so when you're looking, and it's really a nice thing when it comes to even looking at day trades right now, you can just see it with the candles here, that when it's closing below the low of the prior candle after an upward move, we're seeing some heavy down. When it's closing above the high from the prior candle after a heavy down, we're seeing some nice chops up. And you can take that and apply that to your daily charts from an investor standpoint and saying, all right, when do I want to step in? When do I want to, be involved or get involved with this stock? I have a partial IBM position. I want a lot more IBM position. I don't have any of that, right? I don't have anything where I can go, well, it's closing above the high from the prior day. I know yesterday it opened up and it rallied and it was up like $4 and it's looking juicy after this pullback, and then today opens up, rallies. Okay, did we find a bottom? No. You're going to be left kind of guessing, hoping, throwing arbitrary numbers out there without one of those two things that we talked about, where you either see that fundamental cheapness and the volume come in, or you get that close above the high from the prior day, and just neither of those are coming in. Neither of them are coming in here for it. Thanks for hopping on. Have yourselves a fantastic day. We'll talk to you tomorrow. Take care.